Good afternoon, everyone. Thank you for joining us today. I'm Michael Episcope, co-CEO of Origin, and I'm here with my partner, friend, and fellow co-CEO, David Scherer. The last webinar we held, I talked about how sentiment was turning across the board, how institutional buyers were starting to come off the sidelines and individuals were generally bullish, looking to either add real estate to their portfolio or hold what they currently have. And a change in sentiment tends to predate full-blown recoveries. And the data we're seeing right now across our own portfolio and then the public REIT sector is really pointing to a recovery in the making. And we've been talking about this for the last 18 months. The market has really been skipping along the bottom. We're not making any predictions about price increases or price recoveries on that side, but it's really the operational data that we're going to go over today. And the reason that we're seeing this operational recovery, it's pretty evident. It's about all the things we've talked about in the past. Supply is getting absorbed, new construction starts are down, job market is strong, and more people are renting because of the inability to own a home. It's just too expensive. And real estate, it's been on the ropes on the multifamily side for the last few years. Historically, it's generated some of the best risk-adjusted returns, so it's not going to be here forever. And we really think that we're on the upswing right now. And so a lot of what we're going to cover today follows this exact theme, a recovery in the making, if you will. And I'm going to cover the state of the fund and review the 1% bonus program, and then I'll hand it off to Dave. He is going to go over several of our existing deals in the pipeline, and review market data. And after that, we're going to open it up for Q&A. This entire presentation should be about an hour. Our portion will be 35 minutes, and then we'll leave the rest for Q&A, and we'll stay a little bit after if we need to. That usually happens. So let's jump into the portfolio now. Everyone's seen the disclaimers. So I'm going to start with just basically the portfolio snapshot. And as I said before, it was about 18 months ago. We said it's time to go on offense. We sort of recognized what we thought was a bottoming in the market. We saw, at least on the horizon, an end to the supply wave. We saw interest rates starting to crest, prices starting to come down. And we really, and the portfolio, it generally looked like the portfolio on the left. It was 60% debt and 40% common equity. And as a manager, when we're thinking about tilting the portfolio, we can't do this on a dime. We really have to think about this 12, 18, even 24 months ahead in order to change the portfolio. And with the old portfolio, what we were looking at a year or 2 years ago, it was predominantly debt. And it was 60% debt, 40% common equity, and that helped us immensely. But debt, it does a great job protecting downside, and it certainly did its job for us in the last few years. But you want to be positioned in an equity position when the market recovers. And so we've slowly moved in that direction. And that's what you see, the donut in the middle. Right? That's where we sit today. Debt is still 48% of the portfolio and moving down. Development is only 7%. Many of those deals are in lease up and have moved into the common core bucket. And the core bucket is now 43%. So we've made considerable progress on those ends. One of our top priorities is getting the development sleeve back up to 20%. This fund is designed with development in it. That is our high margin sleeve. It's only around 7% today, but it's the sleeve that really produces excess returns, because if 20% of your portfolio can produce 20, 30, 40% returns, that significantly adds to the overall return of the portfolio. And so we're not that far away. 7% to 20% looks far away, but it's really comes down to 2 deals. And by year end, we think we will be able to get back here. Some of our preferred equity that's rolling off will be reinvested into debt, and some of it will also go to buy out some of the existing sidecars as well. Let me go into a little more detail in the portfolio. What you hear is the return attribution analysis based on the 3 buckets we have. We have a development bucket, we have a common equity core bucket, and then we also have the debt bucket as well. So in the last 12 months, the core equity sleeve is up 4.7% and contributed 1.8% to the fund's return. This is a weighted average calculation. The core sleeve average, it was close to 40%. So if you multiply 40% times the return of 4.7%, you get to kind of that 1.8%. The development sleeve was up 13.5%, but because it's such a small portion of the fund, it only added 0.9% to the overall return. And so again, this is why development is a top priority, getting it back to that 20%. And it really wasn't long ago that development produced returns in excess of 20, 30, 40. We think some of those outlier days are ahead. The largest contributor to the total return is preferred equity, or the debt sleeve, and that generated 11.8% return on the sleeve, and that's about 6.4% of the overall fund's return. And so that for the last few years has done the heavy lifting for the fund, and that's what really protected us. And when you have 60% of the fund earning around 12%, the other part of the portfolio, in the past years, it wasn't carrying its weight. In fact, you saw the common equity side of the portfolio actually go negative, but the overall fund return positive as a result. So this has really helped us immensely. When you add all those sleeves up, what you get is a gross return around 9.1%. You get 7.1% net return, and that's the net return to investors. And I'll go over the track record here in a little bit. But I think one thing to call out here is what we're seeing here are the early stages of these other two parts start to shine. If you have attended previous webinars, you would have seen that core bucket negative, or even the development bucket in the high single digits or mid single digits. And anyone, I would liken this to kind of the stock market. These are starting to shine. These are starting to see those early signs of a recovery. This is what we're talking about when we're looking at our own portfolio, the data. And there's a lot on the operational side that David is going to talk about as well. But anybody who studies the stock market or invests in the stock market knows that the best days in the market come after some of the biggest downturns. And real estate is really no different. I was around in 06, 07, 08 during that time. And, the market for 08, 9, some of 10, it started to bottom out and normalize. I think we're beyond that. It feels like we're closer to 11 at this point. But by 12, the market really started taking off in 13 and 14. But that's when the bulk of the money was, the people who really made the highest returns were investing in 11, 12, 13 during that period. And we haven't seen, real appreciation in years. And when it happens, I think it's going to happen quickly. This next slide, excuse me, it really shows what our dividend has done over the last 5 years. And tax efficient income, producing that, generating that for our investment partners, it's one of the greatest benefits of this fund, and generally just investing in real estate itself. And what you see in front of you is the dividend we pay on a per unit basis. So it started out at 0.05 cents per unit in 2019. And then today we pay 0.0625 cents per unit. And it doesn't sound like a huge jump, but the reality is that's a 25% growth rate over 6 years. And one of the greatest benefits of owning multifamily real estate over a long period of time is that income grows as rents increase. So anybody who's owned a building for 20, 30, 40 years knows that the cash flow today is more than it was 10 years ago, 20 years ago, 30 years ago. And many people, when they're investing in this fund or real estate, they really discount the importance of cash flow. But historically, cash flow in multifamily real estate has accounted for close to 50% of the total return, right? A lot of people look at the appreciation, and that side is important. Tax efficiency is important. But this fund has really been designed to produce stable returns, tax efficient income. And it's done that for the last few years. But that is a big component of this. So even if you opt into the DRIP, you don't have to take the income. It's still a tremendous part of your return. Today, the yield of the fund, it's around 6.7%, 6.6%, somewhere around there. It's largely shielded from taxes by depreciation, or I should say it's deferred, right? Tax deferred. There's no free lunch in real estate, but it is tax deferred by depreciation itself. And when you think about earning 6.7% on an after-tax basis, you'd have to generate on a taxable equivalent yield, a bond, a corporate bond, something north of 10, maybe even 12%, depending on what state you live in, to generate that same after-tax return. And this is again, we want to make sure that our investors get the true benefit of owning real estate over the long term, the income, the tax efficiency, the appreciation. And that's what this fund is designed to deliver. Now, I do know, I saw this come up in questions. Many of you have been waiting patiently for the appreciation side to appear, and it will come. David and I are also heavily invested in this fund and want the same thing. And we believe that we are on the upswing, and a lot of good data is coming out right now. Here's our track record. When we talk about appreciation, I mean, you can just look across the market. You can look at the public REITs. You can look at other competitors, and you can see in the last 1, 3, and 5 year periods, we're number 1 or 2 in every single category. And I think the 3 year is probably the most important because this was the toughest period. And everybody talks about risk-adjusted returns, and when the market's up, the manager who generally is taking the most risk is going to generate some of the highest returns because they're using the most leverage, they're taking the most business risk. But when the tide goes out, as they say, that's when managers really earn their stripes. And I think that, like we've earned our stripes over the last few years. You can see in the 3 year period, about half the competition lost money during this period. And I'm super proud of what we've been able to accomplish, in the last 3 years and the 5 years and even the 1 year. Some of the comparison here, it's not even apples to apples. It's close. It's all real estate in that respect, but everyone here is a multi-strat manager. And I think that's important because returns always, they have to be adjusted for risk, leverage risk, business plan risk, asset class risk, and multifamily real estate. It's historically been one of the least volatile asset classes in the real estate sector. So in other words, we've produced some of the highest returns while also taking less risk with our capital. What I also find interesting on the table in front of you is at the bottom, you can see the public REIT index. It's leading the category over the last 1 and 3 years, certainly lagging over the last 5 years. But I bring this up because REITs typically lead the private market by 6 to 18 months. And we saw the opposite happen in 2022. They did lead the market, but the public REITs, they peaked in about January of 2022. And by Q3, they were down about 40%. And the repricing hadn't happened yet in the private side. That didn't happen until the end of 22. We started to see softness in the market. Early 2023, the cracks really started to show, but those REITs started much, much earlier because they repriced daily and capital was starting to flee those in mid-2022 as interest rates climbed. What I've witnessed recently, Dave and I talk about this stuff all the time. I follow REIT stocks, he does as well, but between MAA and CPT, these are multifamily only REIT stocks that are in our markets. You should follow them as well if you're in this market. But number one, they're becoming less sensitive to the daily move in interest rates. And that's something different than we saw 2 years ago when rates would go up, REITs would go down. And now we're seeing some resilience around this, or a disconnect. And the other thing that I'm seeing, is just an inverse correlation to the rest of the market. Every time I see the stock market down, tech stocks getting hit, REIT stocks tend to be flat or up. So a lot of the news is starting to be corollary to what you would think would happen in REIT stocks. And even with the 10-year hovering around 4.6 today, apartment REIT stocks are 10 to 20% off their low. And so I say this because it's a great leading indicator and one to keep an eye on. And certainly we watch this as a piece of data ourselves. So I'm going to go into the investor incentive program. And then I'll hand it off to Dave. Most of you have heard about this. I'm sure many of you are on this to learn more about this. You have to invest by the 31st. But we're providing this incentive program because we see this as an incredible point in the cycle. And we want the capital to invest in new developments and tilt the fund as quickly as possible towards common equity. I'll get into this in a little bit more in a second, but the basics of the program are pretty simple. If you invest for an August 1st trade date, you will receive a 1% bonus on your subscription amount. and we will waive any admin fees. So if you invest $250,000, you will receive an additional $2,500 in shares. You can see that over on the left-hand side of the screen there, the way it's depicted. And we pay that out of our own pocket. It's not coming out of the fund. It's not coming out of anywhere. We actually give that. You also get an admin fee waiver on $250,000. The standard admin fee is 1.5%, so that's $3,750. So that puts an additional $6,250 in your pocket on day one, right? So you are really investing 99% of every dollar into the real estate, which it can't be more efficient than that. And that $6,200, it's not insignificant, but it's also not the reason anyone should invest. This program is for investors who have either been considering adding to their position or coming into the fund for the first time. So our goal is really to give people an incentive to get off the sidelines. You have to see value in an investment before you consider fees. We've written about this, right? Look for value before price, and that's what this is. And I tell this to people all the time, don't invest because of fees. That's the tail wagging the dog. That's not what this is. This is an incentive for those who are already considering the fund, for those who see this as the right fund, see us as the right manager, want more real estate exposure, and believe in the thesis of the recovery. If you believe in all of those things, then it's probably the right fund and the right time for you today. So thank you. We're trying to keep this tight. I'm going to give this to Dave. He's got a lot of great detail. He's going to go over the pipeline, some public REIT data, some things in the hopper as well, and then we'll open it up for Q&A after that. So Dave, over to you.
Thank you, Michael. Nice to see everybody again. I think we had just under 1,000 investment partners and people that wanted to learn more. So thanks for the vote of confidence and for joining us today. My job today is to cover what we're actually doing. So I'm going to start with developments that we've been working on behalf of the fund and sidecars. That'll be the first one, Azola. And then I'm going to segue into new developments. As Michael said before, we're pretty bullish right now on this turning and this becoming more of an owner's market. Rents are going to be going up and driving earnings. And we have had some feedback, and I will just say we're not always bullish. We're not cheerleaders for multifamily. In fact, in 2023, Michael and I wrote an article about why we thought rents would be negative nationally. No one does that in our industry, and that almost never happens. Multifamily has only been negative now for a year nationally, 4 times in 100 years. So it's very, very rare, and we called for it. So I don't want to be sort of labeled into I'm a cheerleader for multi. I just observe what I see. We own, we develop, we lend, we have a lot of information, and I'm going to share that with you. So I'm going to just jump in. Azola Desert Ridge. This is a deal we've been working on for quite some time, and we wanted to spend a little bit of time on this specifically because, number one, it's going to be acquired by the IncomePlus Fund, and that's important because it's going to become part of the position. And number two, there's an awful lot of our IncomePlus Fund investors who are in this as a sidecar. Michael mentioned that he and I are very large investors in IncomePlus. I'm also a very large investor in the sidecar, so I would be an example of that. So Azola, one of the things we really like about, before I get into the development side, so we talk a lot about the fundamentals changing. So I'll just mention one statistic here that gets me excited. So Azola is in Phoenix. It's in Desert Ridge, specifically a very exclusive high-end area of Phoenix. But the Phoenix, the city of Phoenix, the MSA, in 2024, it absorbed. In other words, like people wanted to rent 28,000 units in 2024. In 2025, 24,000 units, and projected in 2026, somewhere between 20 and 25,000 units. That's the demand for units in Phoenix. Supply in 2026, 16,000 units. That's versus 20 to 25,000 that are projected to be absorbed. And then importantly, in 2027, supply drops to 8,000 to 9,000 units. Absorption, it's too early to have that statistic, but let's just say it's average 20 to 25,000. So what I'm trying to show you is this is true of lots of the cities we're in. We're at the turn. This is the last year, and I know that you've heard this for a year or even 18 months if I've been saying it, but it's the last year you're going to see high supply, and it's going to plummet. In Phoenix, it's going from 16,000 to 8 to 9, but demand isn't going anywhere, and there's lots of reasons for that. I'm not going to get into the fundamentals other than maybe in Q&A because I feel like you've heard it a lot. But the gist of it is the demand's never been higher because the cost of rent is 50% cheaper than the cost to own. And so we're capturing the majority of the household formation is going to rentals in the United States, period. And so that's driving the demand side, and the supply side has really hit a wall because when the Fed started raising rates, new starts stopped. And Michael covered that. So Azola, I'm gonna go a little bit into the development itself. Azola Desert Ridge, a 2026 construction phase asset that's transitioning to lease up. Framing and roofing are complete across all 4 buildings. Permanent power is live. The community manager is on site. The property's been listed. First units are targeted for Q4 of this year, and the amenity building and leasing clubhouse is on track for Q3 of this year. The project is running ahead of budget. We've carried $1.7 million in savings relative to budget to this point, meaning that it's highly likely that we will have savings. This is another thing just to take a step back because this is applicable to most construction at this point. The reason we like this construction vintage right now, it's not just that the fundamentals are turning, it's also because the cost to build isn't going up. And the reason it isn't going up, it's a little counterintuitive. We wrote an article on this. If anybody wants to see it, it's probably on our website, or you can ask me and Michael and we'll have our team send it to you. But although oil is an input to a lot of materials, that would be where the logical brain goes. Because there's so few starts right now, the general contractors and subcontractors are taking jobs for much, much lower margins just to keep busy. And so what we're seeing is flat to lower year-over-year construction costs. And you're seeing it in real time at Azola. We actually have 1.7 million of savings off a construction budget that was lower than we thought in the first place. And why does this matter to IncomePlus Fund investors? IncomePlus already holds a position in Azola, and we believe that this fund will be acquiring the additional sidecar interest via a 721 exchange. That means a tax-deferred exchange. So if you're in the sidecar, you may see that there's a lot of value in taking that fairly significant gain because real money's been made here in the sidecar, and not paying taxes on it and deferring those taxes into a later date. You'll be in the IncomePlus Fund essentially at a tax-free deferral. And so that's an example of an in-process development. So now I'm going to move to what's happening next. So these are new developments. Michael was talking about how not only do we want to move the fund from a very defensive posture, 55-60% credit, and much less in equity. So, 35-40% in equity. And that was by design. We wanted in 22 to be much more conservative and defensive. And that's one of the reasons we have outperformed our competitors. Origin didn't buy a building for 4 years, a stabilized cash flowing building. From 22 until late 25, we didn't buy a building. I mean, to give you an idea of what we thought of fundamentals, and now we have a different opinion. And so these are new developments. We need to replenish the 20% development sleeve. And so that's what this is doing. And so let me just describe a little bit about these deals and why we like them. The Ellison, again, it's in Chandler, which is a submarket of Phoenix. Very high-end demographics. It's within 10 miles of Taiwan Semiconductor's $65 billion campus. Also, Intel's Ocotillo campus. Plenty of demand drivers, which is creating the demand for rentals as well. And we're building at a new reset economics, much lower construction costs, much lower prices of land, very competitively bid projects. Again, GCs and subs are willing to take much low margins. And this arrives at a 6.4 return on cost. We're pretty confident in that from the cost side, because the construction contract is negotiated, it's bought out, and we've commenced construction. This results in a 35% margin to where stabilized assets trade today. That's pretty large. I mean, we get excited about deals to our underwriting when they exceed, 26, 27, 28. And this is all the way to 35. So we're very pleased with where the margin of this deal is shaping up to be for the fund. And then I'm going to speak about Brickyard a little bit. Brickyard, it's in one of Denver's premier high-end, high barrier suburbs. Household income here is over 160,000, which is obviously quite high. And we're building it with a local developer, I should say regional, called Confluence. They've done over 5,000 units in Denver. It sits in a 31-acre master plan, but importantly, we're only doing the multifamily element. But there's many other elements. There's a regional sports center, among others, lots of retail. That's not part of this project, but it's obviously activating the community. And then the project itself carries $18 million of public incentives, roughly $60,000 a unit, which funds a parking structure, infrastructure. It allows us to build podium product below the cost of garden construction. That's a basis no one can ever replicate. So we're really excited about this deal. No one's going to be building this high quality, and we have lots of incentives to help both protect the compass that Michael and I have used for 18 years, and it's served us and our investors very well, is protect and grow. It's always protect and grow. And so when I think about 18 million of incentives, I'm thinking about protecting. That's your downside protection. And then you play offense, then you grow. And that served us very well. I'm going to move on to the next layer, which would be pipeline. And so these are actually two slides, but the first pipeline deal is actually in Nashville. And this is a deal that we're relatively, I would say we're 90% likely to do. And the reason I say 90 is we're still negotiating the operating agreement at this point. So I'm relatively confident, but not certain. But I am going to describe it a bit. We've been working on this for well over a year. Alta 60th, it would be 296 units in the nations. This is Nashville's fastest growing urban adjacent neighborhood. Population has grown 38% over the last decade. Median household income's $100,000 per household. We're partnering with Wood Partners, one of the largest multifamily developers in the country. They've done 3,000 units in Nashville alone, but they are national. The basis is what we're most excited about here. They've been able to acquire and get entitlements for surface parked construction, which leads to a much lower basis. But if it's well done and executed, you get similar rents. And so our basis here will be $285,000 a door, Class A surface parked. There are two comps we can point to, Modera Nations and Camden Nations, both competitors of ours, both within a mile, and their bases were $380,000 and $468,000 a door. I'm not suggesting that we're going to be that big, but I love being in at 285 when there's deals getting done between 380 and 470 within a stone's throw. Like I like these are the types of deals that excite me personally. So I'm very interested in getting this deal into the IncomePlus development sleeve. And then the last, I'm gonna have to be very high level here. We're in, I would say, mid-stage negotiations here with a partner, but our west office out of Denver has been negotiating for quite a while. These are two deals we're negotiating at the same time. In total, it'll be about 25 million of equity, and they're both well located near the Durango Casino. What's interesting about this deal, great developer, great basis, but also the IncomePlus Fund is going to be getting control on both of these deals with an enormous amount of alignment with our partner, because they're very well capitalized and they're very excited about these sites. So they want to put significant of their own capital in. And so more on this as it unfolds. Hopefully in the next update, we can tell you that this is now done and we're moving towards it. So one of the things I'm going to do different, I'm transitioning into fundamentals, and I'm going to probably only take 5 more minutes because I want to have plenty of time for Q&A. But what I'm not going to do is talk about what we believe and what Multilytics, our AI, thinks. We've done that a lot. I want to just now do it a little bit differently. We're going to present evidence. Like it's not what we believe will happen. It's happening now. And so this is just sort of the high level of where we've been. Yes, prices peaked in 2022. That shouldn't surprise you. The Fed started raising rates. Construction starts really cratered. In other words, people stopped starting new development in 23, 24, 25, but the supply was still delivering. And so you see, pricing going down in 24, and then as Michael alluded to, it's kind of been bouncing around the bottom, and now it's starting to move up for the first time, and I'll show you what I mean by that. So before rents can go up, occupancy has to go up, right? Because that's creating a supply-demand imbalance, and that's happened. And then more importantly, it's happened in our portfolio. Again, not theoretical. So this is this year. If you're talking about January, Feb, March, April, May, we've had a significant demand increase. I mean, you're talking about going from 88% to 95%. That's massive in multifamily. And also, if you look at just the real page, that's sort of our very large data set average. They've also gone up, 91 to 93. So directionally, it's moving the right way. And demand in our lease-ups mirror this. So when we complete a building and the construction is done, it's 0% occupied. And so you've got to do an awful lot of leasing. And when we're modeling, we typically model anywhere between 14 to 20 leases a month. It depends on the market and demand and what we believe, or even idiosyncratic, the competitive set, how many other deals are around that also need to be leased up. All matters. But Rise Bay Meadows, 27 net leases per month, that's a big number. Rise Sorrento's 17.3, that's the high end of what we model. So we're seeing this pickup. This wouldn't have been this level a year and a half ago. And Michael mentioned some of our publicly traded apartment REITs. What we know, so in the last, let's say 2 months, in the last 2 to 3 months, these stocks are up 15%. Now, we know for a fact it's not because of interest rates. Interest rates are higher, right? So we went to war with Iran around March 1st. So April, May, June, we're 3 months later. I mean, rates are 10% higher at minimum than they were. So that's usually bad for apartment REITs. They tend to go down, not up. And the reason they're going up is the fundamentals are perceived as by the market as stronger than the interest rate influence. And their occupancy is corroborated. You're looking at the same type of occupancy that Origin has in the IncomePlus Fund. Historically, these are very strong numbers. And then what I said earlier, as you see higher occupancy, ultimately that produces higher rents. And we measure rents on a net effective basis, both in our AI, but also just our investment management team. Net effective means net of concessions. It's what you charge net of any concessions you're giving, a week free, a month free, whatever it is. And so on a net effective basis, rents have now turned positive, and we believe this is going to be a trend. And that is all of my slides. Hopefully we'll cover the rest in Q&A, and Michael, please take the first one, and I'll take the second.
Great, thanks, Dave. I'll just start with the first one. This was actually emailed in, but I think it's important. It's probably one that everybody wants to know. And the question is, I would appreciate your thoughts on the direction of cap rates. They seem to be offsetting any benefits from increases in effective rents as concessions burn off. Is that perception incorrect based on what you are seeing? The only thing we can say about cap rates is we know where they are definitively today. They're probably anywhere. In the last 6 months, we've seen a deal trade at 4.5. We've seen other deals trade at 5.25. And it really has to do with where they're located, barriers to entry, the markets, things like that. We've seen some crazy prices go off. Generally, things are trading, around replacement cost today. Certain markets are trading a little bit below. Certain markets are trading a little bit above. But the great equalizer to all this is rents. But we haven't seen, like what David showed, is a small rise in rents. And what you first get in a recovery is concessions, right, that disappear. So instead of giving 3 months as you get into 95% occupancy, now you're giving 2 months and you're trying to stabilize the property. Then you're giving 1 month. But all of those concessions, when you're burning them off, they lead to more and more revenue at the property. And when you get to the point where you don't have to give away free rent, then you can start really raising rent. So we're not quite there yet in terms of the recovery, but revenue is the great equalizer. I kind of said that before in my part, that even in the face of high rents, cap rates where there are, revenue revenue solves all problems in those situations. So I do think we're in the operational expansion period here, but make no, we haven't seen anything change really on the pricing side, right? That could happen in the future. We're going to need a little help from the capital markets, but if we don't get help from the capital markets, then even revenue, given all things, being equal, the same multiple, that can also create price expansion as well. Gene asked, any of the development projects requiring sidecars? Gene, most likely, and I would say for anybody on this call, if you have an interest in participating in individual deals in sidecars, those always go out first to IncomePlus investors, but reach out to our investor relations department and just let them know that you're interested, and you'll get a first call on these deals.
I will take 2 as well. These are all emailed in. Thanks for doing that. And they don't have names, so I can't read them. What is the biggest threat to Origin's bullish outlook? I would say anything that changes the demand curve is one. And so when we talk about the future, we know supply is going to be much lower because it didn't start. The supply that should have been created had to start in 23, 24, 25. It didn't. The demand, when I talk about future demand, I just assume it's the same. Like the reality I'm looking at today is similar to tomorrow. I'm not saying it's getting better, but something that disrupts demand, like a severe recession, that would reduce household formation. So that would be a threat, right? Anything that's going to produce that. And then the other obvious threat, we do need to borrow money in our business model. So anything that produces much higher interest rates that are sustained over time would be also a threat. I would say both of the things I just mentioned are threats to all stock investments too. Like there's no free lunch anywhere. Like if what I'm saying happens, that would be bad for any capital asset. So those are the things that also can affect us. And then the other is common advice. This is a different question. Common advice for stock market investing is to avoid market timing. To what extent is market timing appropriate in real estate? This might surprise you. I actually do believe you should sort of market time in real estate. You should be a long-term investor. But certain times when it gets really stretched one way or another, to me, it seems pretty obvious. In 2021, when we were trading at a 28 to 30 multiple, that makes no sense. Our asset grows by 3%. That's our rent. Like historically, over 100 years, we grow by 3%. 3% growth assets don't trade at 28 multiples. That makes no sense. And so there are times where if you're astute, you should be able to avoid some traps. And I think we've done that here. I mentioned we didn't buy an asset for 4 years. That's because of what I just said. It didn't make sense, so we stopped.
Kevin asked the question, curious where loan to cost and loan to value will be over the next year, and the debt coverage ratio, as I think it is not much above 1. If things go south, could that put pressure on cost of capital and the portfolio? What is your DSCR target versus where it is now? Thank you very much for all you guys do. Kevin, good question. I mean, the market itself, it's going to be dictated by the higher interest rates. So as we see the 10-year go to 4.6, the spreads are going to be a function of, or at least the loan to cost ratios. Banks today are kind of in that 60%. So there's a lot of equity that has to go into these deals, which is, to Dave's point and what we've been talking about, putting a damper on new development. All right, it's very difficult to come up with 40%, but certainly, for debt portfolio, or I should say debt lenders and things like that, groups, even like what we're doing with the IncomePlus Fund, where we're positioning ourselves in the mezzanine tranche. It's a great time to be lending, and that is one component of this fund. But you're right, if things go south, certainly where individuals, a lot of these projects are sitting today that are trying to get through lease up, we've seen a lot of developers have to put in more money. Banks are requiring this. They're running out of interest reserve, and they're trying to get to lease up and get to the other side here. So loan to cost, loan to value is about the same, right? When you're looking at these things, because everyone's pricing it to a debt service coverage ratio. And, banks want to see that at about 1.25, 1.2, right around there when you're stabilized. And that really hasn't changed. And certainly the higher interest rates are, the less they're going to lend against the project. So I do think it's going to create some opportunities. And there are some projects out there, not great ones. And this is the problem. The market's always bifurcated between really good Class A projects that are never on sale, but you have to find a way to buy them and peel them away. And then stuff that you don't really want to own that is for sale, that's struggling. And then you have to ask, well, why is it struggling? Well, probably because it's not in a great location. It's not driving demand. And that's a constant battle that we are looking at all the time. So I hope that answers your question. Thank you. We really appreciate you as a partner. And thank you for listening today.
Okay, my question, what are your concerns about rent control legislation or tenant protection legislation, such as limits on eviction? We're concerned about it, and that's why we don't invest in cities and states that do it. And so notice where we don't invest: California, New York. These are the places that, Michael and I don't like to invest in things where we can't quantify variables, right? I can't quantify what they're going to do. And so it's not political, but we tend to invest in red states. Think about where we are: North Carolina, Georgia, Florida, Texas. The only one that isn't really red is Colorado. It's kind of purple. But, we really do avoid. That's why, we don't invest in Chicago. We're headquartered in Chicago. There's a reason. We have a real fiscal issue, and it's a lot easier to tax large landlords like us than a bunch of homeowners, or more votes, if you will. So we just take our lunchbox and go somewhere else. But I'm concerned about it, and I wouldn't advocate investing in those areas for that reason, unless you're getting paid with a much lower basis, a much better cap rate. Like, something else has to be really attractive.
Dave, we've gotten a few questions about that. John asked something similar, just about real estate owners being handcuffed in their ability to raise future rents because of potential socialism sentiment. And, Dave just answered that question, John, in many ways. We are cognizant of that. I think that these policies are going to have really unintended downstream consequences. And ultimately what they're going to do by doing this is limit the amount of building, and it's going to cause all kinds of perverse incentives in the market and do the opposite of what they want. Unfortunately, these are becoming popular in these really, really dark blue states, and it's going to backfire in the long run. If you want affordable housing, you build more. That's it, bottom line. And so another question that we got was really about the legislation that's been in Congress. A lot of it has to do with build for rent, and that put the brakes on that market for a long time, and projects have been stalled, and it was a little nerve-wracking to see the first version of that. But a lot of smart people have now opined on the bill, and it looks like what is ultimately going to be passed is something a little bit more reasonable. Maybe it opines or not so, appeals to some Democrats and some Republicans at the same time. But we largely should not be impacted by that at all with any of our build for rent properties. So it looks like that's going to pass. It's obviously being held hostage a little bit too with some of these other negotiations. But it was maybe a little bit concerned, but glad there are some people in Congress with some level heads on.
We have a lot of questions about interest rates. People are concerned about interest rates going up. And so I don't have an opinion on interest rates. I did when they were really, really low. I thought that they would go higher. We actually hedged them, and it worked very well. It saved our investors quite a bit of money, the hedge did. But right now, 4.6 in the 10s, there's two things going on, right? Yes, the Iran war, oil's up, all that, but the market can't decide if the Fed's going to cut, remain unchanged, or raise rates. And literally going into this year, they were going to cut 2 or 3 times. Now, kind of base case is they'll do nothing or raise once. B of A thinks they're going to raise a couple times. So there's been a lot of volatility and expectations on the front end. But then on the back end, to me, there's a tug of war. Certain things are very inflationary. Tariffs are inflationary. The Supreme Court did both those, or they ruled them, I should say, unconstitutional. But certainly there's a lot of tariffs in place that weren't. That's inflationary. Oil is inflationary. But there's also this other thing happening, which is this massive AI investment, with the idea being that it's going to yield efficiencies, and that's deflationary. And so that's where my head goes. I actually don't know if rates are going up or down. I certainly wouldn't hedge them here and say, I believe, because when I hedge, it's mainly because I think there's an asymmetric distribution towards higher. I don't believe that. But the question always comes up, what happens if rates go up? The answer is, it depends. It depends if rates are going up because the economy's strong and our EBITDA is going up, our growth rate's going up. That can be just fine. But if they're going up just because of inflationary things and the economy isn't growing and our rents aren't growing, that's not good, right? Again, all of these questions, these risks that are being, it's a question, but it's really more of a risk question. They apply to all assets. So if you're generally bearish and you're moving towards these worlds where you think the asymmetric is always more bad than good, then you should probably position your entire portfolio as very defensive because it'll all be affected similarly.
Dave, I love that answer, and I want to touch on it because there's a lot of people here, asking about risk, and I love framing it around that asymmetric. And what Dave and I are saying, it is possible that the fund goes down in value from here if you invest today, and it's no different than investing in the stock market. If you or anybody on this call has ever invested in individual stocks, right, there is an asymmetric risk profile that you create in your mind and saying, this is a good risk reward from here. And if you buy a stock at 50 and goes to 40, you're kind of bummed, except if you're going to hold it for 10 years or 5 years or 3 years. But when that stock goes to 200 and you look back at that $50, it feels like the low. And that's what we're talking about here, is that we don't have perfect information, but what we feel like we're setting up for today is an asymmetric return profile. And we want everybody to understand, if you make an investment in this fund today, tomorrow, in a year, there's no perfect timing. And I just want to say that because a lot of these questions are around risk and timing and everything else. And I know that the theme here has been around that. So I'm going to get to a question now. Craig asks, this is about timing a little bit, but when will multifamily rents start more significantly reset higher? Is that another 6 months away as last cycle's inventory? Craig, I'll answer it this, right? I always think about things in a range, but in my experience, I've been investing in the markets for the last 35 years, and you can be right on the direction, but what you're never right on is the timing of the direction. And markets always recover a lot faster than you could have ever imagined, or slower than you thought. And so it could be that in certain markets, we're looking at 2 to 3 months away and we're going to see these things. But if anybody has been reading the papers, you see the headlines, and the headlines are starting to change everywhere across the United States when it comes to real estate. And it could be that it's another 12 months or 15 months. So what we are very bullish on is that operations are starting to improve, insurance is coming down, that rents are starting to rise, concessions are burning off, occupancy is going up. These are all the things that we can see today, and it's much different than they were a year ago. So I appreciate the question, and I just wanted to kind of lay that out for everybody about the where we are in the cycle and the timing and the expectations about this fund.
I'm going to answer Kai's question. Michael, please answer Rod's afterwards about the Starling DST and the timing. But Kai asked a question about adding leverage to the portfolio. Do we plan to add leverage to the IncomePlus Fund? No, we don't. It's, again, what I said before, protect and grow. That's what we do at Origin. And we try to take the least risk possible to still get you a great return. So no, we're not going to use more leverage in the hopes of getting higher returns. We don't do that.
Rod asked the question, will the Starling DST be acquired by the fund in 2026 or 2027? Rod, that's going to be 2027 because we have to wait 2 years until the seasoning period. So 2 years from the last investor coming in there before we can actually acquire that. And then it will be at the option of the IncomePlus Fund to acquire that deal. But that's a deal, for those of you who don't know it, it's a 1031 exchange deal, and ultimately the IncomePlus Fund will acquire that deal through a 721 exchange. Russell asked the question, if interest rates go up, would you need to sell assets to cover liabilities? No, Russell, but I mean, everything depends. I mean, if they go up to, they're 4.6, if they go up to 5.5, it's very different when, rates go from 1.5% to 5%, like we saw between 2022 and 2024. During that period, that was a 4 standard deviation in interest rates, right? Rates going up from 4.6 to 5.5 is a 1 standard deviation. So the answer is no. But what I always tell people, it depends on what your framework is, right? If you think they're going to 6, 7, 8%, then things might be a little different, right? And so, that is, would we have to sell? I'm not sure, right? We'd be on the other side and have debt that would help offset the portfolio. But in a normal interest rate rising environment, we're fine, we're hedged. And when I say hedged, we have long-term fixed rate debt on a lot of our properties. And we also have the debt portfolio that's helping with this portfolio performance.
Parker asked, are there any anticipated sidecars in the pipeline? We do potentially have sidecars. It's very hard for us to know, because if a lot of money is coming into IncomePlus, then that money is going to be allocated to the developments. And if the development need equity exceeds that's how sidecars happen. So it's hard for me to know at any given point in time, but if you're an investor at Origin, you've seen over time that there are sidecar opportunities that emerge each year. So I would say, based on historically, we will have some, yes.
Jason asked the question, are there any properties that may have financing issues coming up that could be bought right? Yes, Jason, there are. And in fact, this happened a while ago. I think it made it into the last update, but the Goodwin, which is an incredible located asset in Austin, we essentially have taken that over because the developer called uncle, right? They have $25 million of equity in the project. The bank wanted more money, and they just didn't want to put any more in. So we're essentially operating that asset. We own it at this point. It is equity, and we're super excited. Well located. Our basis is far below replacement cost. And Austin, that's a market we'll bet on all day long. I mean, there's a lot of great stuff happening there right now. So like things are coming in, and it's hard to buy an asset because people just aren't selling assets like that. So that's another way that we can acquire it. Austin does, it's got some supply issues, and it will be a late recovery market. But like the analogy I gave before, it's like buying a stock for 50. Even if it goes to 40 in 3 years when it's at 200, you're very, very happy. So I can't tell you that we bought the low today, but I do know we bought a great asset in a market that we love, that is well positioned with operational data that just, that's getting better and better. Occupancy is proving, leasing traffic. So we're getting a lot of good information there. And then there's, one or two more that we're considering right now. And those are the ones that you've heard about that are really these deals that have been on the watch list in terms of the IncomePlus Fund. So we've got about 3 of them in total that we're looking at. But Goodwin is a great example.
Thomas asked a question about demand for build-to-rent townhomes. Do you see Origin acquiring projects like this? Yeah, potentially for 1031, which would then 721. But we are developing quite a few build for rent. Not in this fund, but QOZ, Sawtell, we have a site that's we're super excited about that's built for rent, but many others too. And yes, Michael was right. That legislation, it delayed our projects too, because we had no certainty on how you would sell once built. But that's actually, it has been resolved very recently. The House and Senate passed the bill. President Trump wouldn't sign it because he wanted to get the Voting Acts bill attached to it. But I was funny. I had a meeting earlier today, and we were talking about this with a client. And one of the things the last 6 or 8 years has done for me, I've learned a lot about like how the government works and what happens because it's such strange times, right? So I'll just say, I didn't cover this in civics class. If a bill is passed by the House and the Senate and the president won't sign it, he can veto it, he or she can veto it, or they can sign it. They have 10 days. And if it doesn't, they do neither, it becomes law. And so that's what I learned, and that's actually what happened. So that bill is passed, it's signed, it's law, and we have full visibility. And because of that, I would be open to acquiring for 1031, and we'll also be developing again the deals we've been working on because we have visibility, which is nice.
Dave, we are at an hour 4. Our questions are coming down to an end here. So I would just ask, anybody else, if we haven't gotten your questions or you have questions, if you're listening to this as a recording, please email us. You can reach me. Well, our emails are right in front of you, Michael at Origin Investments and then David at Origin Investments. We will respond or give it to somebody in investor relations to get back to you right away. Dave, this was great. Do you want to sign us off here?
Yeah, of course. Michael, really always love doing webinars with you. It's takes us back to the early days when it was always just me and you. But in terms of folks that have joined, thank you for your vote of confidence if you partnered. And if you're considering partnering, you can reach out to us. Any questions, a good question. We want you to make informed decisions. Have a great rest of the day.